Good morning and welcome to another Think Tank. Today, we will be covering what to say and how to address your buyers that are deciding to put their search on hold because rates are going up. This is a common issue now as rates have gone from threes a couple months ago to in the mid to high fives. So, if you like the content today, please hit the like button. Please type in any comments if you have any questions or want to say anything, and let's jump right into it. So let's start off with what's going on now, and that buyers are putting their search on hold or stopping it completely because the rates have gone up, and either they have to get less of a house or can't afford the house that they want, or say to themselves, I couldn't afford the house in the last 6 months because we kept getting outbid. So what are the chances are with higher payments that I'm going to get what I want? Well, let's start off with the according to who rule. And that according to who rule is that sometimes people don't want to hear things from you, myself, Carl, even though we could have the right data and information. So sometimes you do have to give them reference points and the information according to someone else. This is very common. And who could the someone else be? Well, there's tons of articles and data that I'm sure you guys see, read, and receive daily. And a couple of the big news outlets are RIS Media, RIS Media, Keeping Current Matters, Inman News, even often sometimes Zillow provides some articles on where they see the market going. So sometimes those are the places where you need to send them some articles with some graphs and charts showing that we're not due for a market crash that we had in 2008. That's not coming around again. We are looking for the market to at some point stabilize, but stabilize doesn't mean prices are going down, nor that rates are going down, and that they should put their home search on hold. Actually, it's kind of been the opposite. For those of you following any of those outlets and articles, they're saying that the appreciation is going to continue to go up, not at the 15 to 20% appreciation rates that we've seen in the last couple of years since the pandemic hit, but we probably will get back somewhere to our norms, 2 to 3% or 3 to 5%, which is still a little aggressive, but they still forecast that prices will appreciate and rates nonetheless will continue to go up. So a lot of the economists have said that they anticipate rates being above 6% by the end of the year. No one has a crystal ball, and we're not here to give our projections. But according to who, giving them some factual data or some data derived from someone other than us sometimes goes over very well because they look at it as it's just you, it's just Olivier, and you're just one person. How could you know it all? Which we're not saying we do, but being in the business, doing our research, we have access to enough information to kind of make an educated prediction of where things are going. And sometimes giving it to them from a Keeping Current Matters, RIS Media, Inman News, et cetera, would really help them overcome that. Second, other than the articles and the accordings to who, always explain and interpret the data to them and explain that the crash that they're waiting for is not likely because in 2008, what caused that crash was a perfect storm of many things that had gone wrong. And there's been so many laws and different departments, the CFPB, et cetera, that have been created to ensure that we don't go through this again. And if you look at different charts and graphs, that we've always had appreciation in home values. This has been the biggest dip overall. And that was because of the 2008 crash was the biggest dip. But without that kind of perfect storm, it's very unlikely we're going to see another crash. And rates are cyclical in the sense that the rates have gone up and down historically over time, and it's going to be many, many years, if ever again, we see a below 3% that we had for a while, which was almost free money and too cheap to obviously to maintain. But interpreting the data and giving them why it's not going to crash and why it's not likely to happen really helps because they think, well, it crashed once, it can crash again, and I'll just wait to catch a good deal then. we know that's not likely. They don't really understand why that happened. They just think these things happen because they're not in our industry. So they don't understand what the perfect storm was. So if you can interpret that and really break that down to them, that will really help, putting it in layman's terms of why we believe that this won't happen again, and what not only HUD, but the federal government and all the banks have done to really ensure that something like that does not happen again. Um, the other thing is, you can't time interest rates, right? So while I'll wait for the rate to come back down, you cannot time interest rates. They fluctuate daily, as you guys know. And even if the rates were to dip for whatever reason, let's say we're at, and these are not the real numbers, guys, but just for an example, let's say today we're at 5.5% interest. Um, and for whatever reason they dip to 4.75 next week. Well, what's the likelihood that you'll be able to time that and say, well, I'll wait for them to go under 5? They dip in a week or 2 weeks to 4.75, and you say, great, I'll buy a house today. Well, you're not going to find a house that day, right? It's not like Target and you can go pick one up off the shelf. You cannot really time interest rates. That's why you lock in the rate once you go under contract, or if there's some reason we have an understanding that the rates will be going up. If you can lock it in early, you do. But it's very, very, very hard for a buyer pre-property, pre-finding something, to lock in the interest rate, or really time the interest rate. So you can't really do that, as by the time you find something, that rate's probably not available as they fluctuate. So if you explain that to them, how it works, that even if the rate were to dip for a couple days, that doesn't mean you can go out in a day or two and find a property and lock it in. So waiting doesn't really help in trying to time the interest rate, because waiting, just look at what's happened in the last 2 years. Buyers at the beginning of the pandemic that said these prices are going up too high, too fast, I'll wait it out. Well, in the last 2 years, they've waited to today where the same house costs more money and now the rates are much higher. So you can't really time rates. And that's something to really have a conversation with and let them know. Another thing is uh, price increases. So as I mentioned before, I read this in a couple articles that they are anticipating 2023, 2024 for homes to continue to appreciate. No one is anticipating a crash. No economist has mentioned a crash, even with a looming possible recession. But they do anticipate that we will get to a normal amount of appreciation, maybe slightly higher. So what normal appreciation is annually is 2 to 3%, but who knows, it might be 3 to 5%, but it's not going to be this, hockey stick that we've been going up to a opposite. No, it's not going to crash. It could stabilize, which means there's still appreciation. So either way, the cost of that house costs you more by waiting, because as the rates fluctuate, the prices through inflation, et cetera, are going to keep going up. So if you wait, regardless of what the rate does, you get a little bit less house if your budget is maxed at 400,000, because prices are going to keep going up. And that's something that you can send them through multiple articles so they could see, not according to Olivier, but according to The Economist and these massive companies that have research teams and spend millions and millions of dollars researching and figuring out what's going on so they can project and properly, invest their assets. If they are saying that this is what's coming down the pike, it's very likely, if there's a consistency across the CNBCs and all these other real estate outlets, that that's really what's likely to happen. So you may want to show them some data on the fact that homes will continue to appreciate. There's not a crash coming. So with that, even if the rates can vary half a point to a point, if the prices of the homes keep going up, it affects them equally. So not to put their search on hold. I also believe in calculating the monthly payment, right? The rate being 4%, 5%, 6%, obviously you're paying more interest as the rate gets higher. But if you can afford the home, you can afford the home. And I think that's more concerning, because if the rates were 1%, but the loan amount or the monthly payment is something that you can't afford, if your monthly budget is $3,000 a month, and even at 1%, that home is $3,500 a month, it doesn't matter that you're at 1%. Same goes if the interest rate is at 5 or 6% and you can't afford it. Well, that's what you need to worry about, right? So really having them get a better understanding of a 400, a 500, a 600, a $300,000 house, what that monthly payment looks like with taxes and all in, that can get them to be more comfortable, because buyers tend to focus on the wrong numbers, which are their interest rates. And we know a lot of times they look at the published rate and not really understanding what the APR is. You know, they're so worried about the house price, they won't come up another $5,000 to win the offer on the house. But we know what $5,000 breaks down to. It's minimal. It's less than a Starbucks coffee a day. But it's really getting them to understand the real number they need to be concerned about is the monthly payment, outside of them, of course, having enough down payment and closing costs to purchase. So have them speak to their lender about the monthly payment, as that is a key metric and number that they really need to be concerned about, a little bit more than the rate. So definitely have them figure out the monthly payment. So the other thing is the benefit of owning homes versus continuing to pay rent, right? And there's tax benefits, which we know. Don't get into exactly what they are and tell them, well, you can write off X amount of your property taxes. Although we may know the number, we're not accountants, so that's not our role. There's interest deductions, right? Your interest that you pay in your mortgage, that's a deduction. Again, don't get into how much they're going to save or make by, save by having a mortgage and paying interest. That's a great question for their accountant. But ultimately, I would turn that around into starting off with some of the benefits, of owning a home and the financial benefits, to then turning that around to, well, since you've been renting, how much money or equity have you built and made, right? We know the answer is zero. You don't make money owning a home. Renting a home. You do not make money renting a home, but there are a lot of benefits of owning. So turning that around and getting them to self-discover, letting them figure out that aha moment themselves. And by asking questions, you can lead them there of how much money have you made since you started renting? How many years has it been since you started renting? What have you paid in? 1,500 a month is 18,000 a year. 10 years is 180,000. 10 years later, how much equity do you have off that 180? Answer zero, right? Help them self-discover that ultimately, even if the market's flat, paying down the mortgage plus the other benefits really helps them. So it was almost free money at 2 to 3% interest, but that wasn't sustainable. But that doesn't mean 5 and 6 are not a bad number, right? 5 and 6 are still historically low for overall for interest rates. So explaining that can really help them sometimes understand that it's not like it's gone from 3 to 10%. And there was, I forget what decade, but the rates were in the teens. We're not there, right? 5% interest is still very fair, considering historically it's been in the teens. So we're definitely a third off of the highs. And last but not least, just remind them, the interest rate on renting is 100%. So Bank of America, Wells Fargo, whatever the lender is charging you 5 to 6. But if you're renting, it's 100% because you build zero equity and have zero benefit to renting, other than, the lack of responsibility. But there's so much upside in buying. So overall, guys, the theme to helping buyers self-discover that it is still a good time to buy and stay in the market is that ultimately they can't control the rates and time it perfectly. Two, give them the data from someone else, different according to who and not just according to you. And three, just help them understand that home ownership is still a great benefit. And if it takes them another year, 2 years, 3 years, because they're deciding to put it on hold, they lose that benefit for the next couple of years. So that is my strategy on handling the rising rates and how to keep buyers in the game. Any questions on that, please chime in, let me know. Any feedback with different approaches, definitely share with us. And if you like this and think these think tanks are helpful, hit the like button and definitely put in some comments. I will see you guys next week.